All right, good morning, everyone. We're going to get started. So my name is Joe Schroeder. I'm from Lawley Insurance. We are the insurance broker for Medical Health Associates. So we work with Chris, Carrie, Kelsey to help, get your benefits package together, make sure it's competitive in the marketplace. So we're going to run through the benefits for your plan year starting December 1st, 2022. And the benefits will run through November 30th, 2023. We also have Dom Manfredo from Univera Healthcare. He's sitting next to me. He's going to be talking in a couple slides on the medical benefits. So what to expect for this year? The medical insurance will be remaining with Univera. No changes to the benefits this year, so that's a positive. New ID cards will go out to anyone that's on the medical plan, so make sure you're checking your mail towards the end of November. Just making sure you have your new ID card ready to go for December 1st. If you're in one of the qualified high deductible plans, so any of the 4 plans that say HSA next to it, you can open up a health savings account. So we'll talk about that briefly. There's also a flexible spending account, so that allows you to use pre-tax dollars to pay for medical expenses. We'll talk about that in a little bit as well. The one call out there is that election will go into effect on January 1st, as it has in past years. All the other benefits are going to be December 1st for the effective date. So what's new this year? The life and disability benefits are currently with the Hartford. They will be moving to Guardian as of December 1st. So most of those are employer paid benefits. You don't have to do anything. You're automatically enrolled if you're a full-time employee. But there's a supplemental life insurance re-enrollment that we're going to talk about that everyone can take advantage of. On the dental, vision, accident, critical illness, hospital indemnity, all those benefits will remain with Guardian with no change in benefit at all. So before we get into Maxwell, just to talk about why open enrollment is important. So this is your one time per year where you can make a change to your benefits without a qualifying life event. Stuff can happen throughout the year. So if you get married, you have a kid, you get divorced, etc., those are all considered qualifying life events. You can change your benefits if something like that happens. It's important if something does happen that you talk to HR. Let Kelsey or Sherry know. You have 30 days from that event date to make an adjustment to your benefits. Otherwise, the benefits that you're electing, you will be locked into for 12 months. So just keep that in mind. Just like in past years, the enrollments will be done through Maxwell Health. So hopefully everyone is familiar and used to going through this process. So this is an online technology. You can go in, you can view your benefits electronically, sign up electronically. There's also a mobile app that you can do the same thing on. So we'll be sending out communications probably in the next 5 to 7 days on when you can go in to elect your benefits for December 1st. We're still in the building phase, so we don't want to throw a date out there and not be able to hit that. So HR will be sending out communications on when you can go in to elect your benefits. But just like in past years, you'll get an email from Maxwell letting you know you can go in to elect your benefits. So that's the same process as it has been in the last couple of years. So as I mentioned, the health insurance is going to continue to be with Univera Healthcare. So with that, I'm going to turn it over to Dom Manfredo, and he's going to cover the Univera slides.
Thank you, Joe, and thank you, everybody, for coming out. Good to see everybody. I've been coming out for a few years now, so hopefully I'm a familiar face, at least. Again, I'm Dom Manfredo from Univera Healthcare. I'm going to walk through real quick the plans and just a few kind of key items I want to bring to the surface so everybody can kind of refresh and know about their plan. So first thing I like to talk about is the network, because as important as it is to understand your benefits and how the plan works, equally important to understand how do you access those benefits, where can I get them. So when we look at the map here up here on the screen, that's our home network. It's not just the 8 counties of Western New York, and you can see the stats there. 100% of the hospitals, 99% of the doctors and strategic physician groups in that sort of lime green shaded area is where you have network access. So you got to drive pretty far to get outside of that. You can even see some of the border counties in PA. We have direct relationships with providers down there. So very vast network. In addition to that, it's not featured on the slide, but important to know, and I do have some literature on it if you need to or you want to see me after. We have a national network wrap as well. It's called Multiplan. If you ever looked on the back of your ID card, there's a little logo on the back that says Multiplan. That's a national network wrap that has, frankly, it's close to 1 million now providers nationwide. The example I use a lot is Cleveland Clinic because, being with our proximity to Cleveland, a lot of folks will, get procedures done there because they're world class, of course. So not only this robust home network, but also a national network wrap. Okay. We also have a network navigator. Her name's Patty Brooker. She engages with members all the time, including members of Medical Health Associates. I know she has in the past few years, folks that are maybe they have a kid in college out of state looking for a doc or something, or a dermatologist or whatever it might be. Patty can help you find, those out of area network doctors. Okay. So network, very important to understand. And we'll move on here. I know I'm probably preaching to the choir on this slide, so I'll be brief. Just remember your preventative services that are covered in full. These are federally mandated services that need to be covered in full. Even if you're on a high deductible plan, you're not going to have a cost share for these services. Okay. Just a reminder there. Another reminder on telemedicine. Okay, you've heard me talk about telemedicine before. I call it the alternative to the urgent care, just like urgent care was the alternative to the emergency room years ago when it came out. We use a vendor called MD Live. We have for years. That's remained unchanged. They have an app you can put right on your phone. You can go to their website. In the booklets that we have in the back, jumping slides here. In the booklets we have in the back here, we have a little flyer about MD Live, and there's an app you can download on your phone. My suggestion is register for the app and the service. That way, when you need it at 2 a.m. or whatever it is, kids sick, whatever, can't sleep, you can use it, and you'll talk to a board certified physician 24 hours a day, 7 days a week. As far as the cost to use it, if you're on the copay plan, which we'll talk about in a minute, there's no cost. If you are on a high deductible plan and maybe you're in your deductible phase still, our negotiated cost with them per service for acute medical is $40. Okay, so it's really kind of like a copay, I guess you could say. All right, so that's that, and that can be used anywhere in the country. Pharmacy, I always like to just remind folks that while it's not required that you use mail order for maintenance medications, it is an option, okay? Mail order does a few things. There's cost savings if you're on the copay plan or in the copay phase of a high deductible plan. You only pay 2 copays for a 90-day supply, okay, versus 3. So right off the bat, there's cost savings there. Even if you're in your deductible phase, there's cost savings because it's going to be a little cheaper per pill to get a 90-day supply, especially from a mail order place, than it is to go fill it each time, where there's a dispensing fee and also it's, just the cost is higher. You buy in volume, you're generally going to get a cheaper rate. So that's good even if you're in your deductible phase. And on top of that is the convenience. I mean, it's a fast-paced world, not everybody has time to run to the pharmacy every month. This way you get it in your mail discreetly every 3 months. Wegmans is one of the ones that participates. I personally use them. They send me text messages when they're filling, when they're shipping, when it's delivered. And I have my HSA card on file and they hit that automatically. It's hands off. I don't have to do anything. Quick question in the back.
If it is a controlled substance that needs like a new prescription every time, do they take care of that or can you not do it?
Controlled substances cannot be shipped through the mail. So, yep. Good question though. All right. So moving on. Wellness rewards. We've had a program on this plan since inception. Actually, it's only a few. I think you guys were one of the first groups that took this benefit. It's called Wellness Your Way. Some of you may be familiar with it. This program, you can get up to $500, $250 per adult towards wellness activities on a preloaded debit card. The way you access it, and again, there's a flyer in the booklet about this. You go on our website, you sign in with a username and password, very simple to set up. You go to the rewards section and you click on a little attestation that says you'll, use this money for towards healthy lifestyle activities and products. And they ship you a debit card. If you're a single contract, you'll get a $250 loaded on it. If you and a spouse do it, you'll get $500 loaded on it. The card is good for several years. It has an expiration date on it, just like any other Visa card or MasterCard. And they'll keep that card because they'll load it each year. Because each year you go online, do the attestation, and they'll load the same card until that card expires, and they'll send you a new one. Okay. So great little benefit there. In addition to that, we have the dental rewards program. That program's neat because if you go for a cleaning, and it doesn't matter if you ran it through your dental insurance or whatever, if you go for a cleaning, submit a claim form, which can again be accessed right on the website, right in the same area that the Wellness Your Way can be. You print out a little form, attach the receipt, and you get a $100 check in the mail later on just for getting a cleaning. The idea there is to incentivize oral wellness because we always refer to the Jim Kelly story. His oral cancer was caught during a routine cleaning, so a lot of trickle down effect from that kind of stuff. Okay. And you can do that up to 3 times, including children. Okay. Up to 3 times on the policy per year. That's why it says a total of 300. Okay. So neat little benefit there. Finally, we'll get into the plans. Now, as Joe indicated before, no changes to these benefits. Okay, so it's going to look very similar. If you're in a plan now, it's going to look the same next year if you stay in it. So I'm just going to kind of go very briefly through the plans just to kind of give you the fields, because maybe you're in the copay plan now, but maybe you're not as versed in the high deductible plans, and those are options for you. Okay, so the copay plan, we've all seen these types of plans before. There's no deductibles to worry about. You go to the doctor, you pay a copay, that's it. You go to the hospital, you're admitted, you pay the $500 copay, that's it, regardless of how long you're in there. Okay, so it's a very simple concept. The cost is higher, but your exposure is much lower when you do go for services. Again, really mainly because there's no deductible to have. Okay, the drug coverage, I'll just hit on real quick. It uses a 3-tier design, $10, $30, and $50 copays. The $10 copay is generics, 30 is brands, 50 are your specialty drugs. Those are the real high cost drugs. Okay. And then again, as I mentioned, 2 copays for a 90-day supply on this one if you do the mail order through Wegmans or Express Scripts. Okay. So quick little slide here. Lawley put together this nice little slide that kind of talks about, gives you a visual of how high deductible plans work. High deductible plan, generally, you got to meet a deductible first, and then your copays start. Once you hit that deductible, it functions very much like a copay plan. Okay. So in the dark blue down on the left, remember I was talking about the preventative services, that's paid for 100%. So that's outside of that deductible. Okay. All other services, you pay 100% of the negotiated fees that we have with each particular provider. You pay 100% until that deductible's met. And then depending on the plan, you might have a copay or co-insurance. Co-insurance just means it's a percentage versus a flat copay. And then we pay that other, the other bulk of it. Okay. Until you hit a maximum out of pocket, and then everything's waived for the year. Okay. So I'll show you what that looks like. So this is the first high deductible plan. And by the way, Joe's going to talk about this a little bit later. You can use an HSA or a health savings account with these high deductible plans. So bear that in mind. So this first plan has it's a $1,500 individual deductible, $3,000 family deductible. What that means, if let's say it's just you on the plan, you're an individual single policy, you need to meet that $1,500 deductible first. Okay, so outside of preventative things, you go for a service, you're paying the cost, and then that accrues throughout the year, and this runs December to December in your guys' case. Once you hit the $1,500, look at the bottom half of the screen here. That's going to work very much like a copay plan, very much like that first plan we looked at. So that's really the only difference there. That deductible does apply to the prescription drug coverage too. Okay, those copays that you see, that's after the deductible. Okay, so again, this is where that mail order can save a few bucks here and there because you're buying volume and only buying 4 times a year instead of 12. Okay, so Important to know. The other thing I like to call out, and all plans have this nowadays, are these out-of-pocket maximums. If you're in, for the example here, if you're an individual, your cap for medical and drug expenses for the year is $5,000. Okay, so that's inclusive of your deductible, right? So you had the $1,500. So if your co-pays and for drug and medical reach $5,000, it's going to be hard to do, granted, but if they do, that's a stop loss. That's sort of a safety net built into plans. There was a time when those did not exist. Okay, now all plans have those. So that's what an out-of-pocket maximum is. And then real quick, I'll just talk about the family deductible, because I'm sure some of you say, well, I'm not a single contract. I got my spouse on it or kids. When you have more than yourself on the policy, the family deductible applies. Okay, so you need to meet the family deductible as a team. Okay, so that can be through any combination of folks. It could be all you meeting the 3,000. It could be you and a spouse, or just your spouse, or any combination of the folks on the policy. Once that $3,000 deductible is met, again, it operates like a copay plan. Okay. Any questions on that? We okay with that? Okay. So these next two plans will go pretty quick because we're just changing a couple variables. So on this one, okay, the deductible's going up. Okay, now what that typically does to the premium is makes it go down a little bit, right? Because there's more cost exposure. There's a trade-off. So on this one, if you're an individual or single, it's a $3,000 deductible. If it's a family, it's a $6,000 deductible. So the family would need to, again, meet it as a team. Has the same out-of-pocket maximum, $5,000 for individual, $10,000 for family. And again, once that deductible is met, it works like a copay plan. Okay. Once you understand one, they all kind of make sense. This one's a little different. It's got a $3,000 individual, $6,000 family deductible, but the difference is everything's covered in full after the deductible on your medical side, at least. So just a little different flavor. Okay. There's still copays after the deductible on prescription drugs, but on all your medical, everything's covered in full. Okay. So again, those plans didn't change. Okay. You probably noticed the one that you're in now. Now you kind of have the full scope of what's out there. Okay. So just a couple little quick plugs before I turn it back over to Joe to go over your ancillary benefits. I mentioned the website. This is what it looks like when you first go there, univerahealthcare.com. Highly encourage you sign up for the username password because that's how you access those wellness and dental rewards I was talking about. But also all this other stuff, you can look at too, the treatment cost calculator. It's a tool you can use to kind of, compare the cost of, let's say, a CAT scan or an MRI. You can see your claims. You can see your explanation of benefits in PDF form. You can download them. You can print them, whatever you got to do. You can look up doctors. Kind of the neatest feature, I think, is the spending accumulators. You can see how far towards your deductible you are, how far towards your out-of-pocket max you are. You can see your benefits and coverage. I mean, anything that you could in the past call us for, there's a self-service option. You can still call us, but there's self-service on the website too. And then finally is the Univera mobile app. I highly recommend, if you do anything, at least get this. It uses the same login and password as the website, but the nicest feature of it is you can view an actual replica of your ID card. Okay, it saved me a couple times. Maybe I didn't bring my insurance card with me, but we all have our phones on us. I don't think we can debate that. You can actually pull up your card, show it to the doctor's office, and it's just like you had the physical card with you. Okay, so you'll always have it with you if you carry your phone everywhere. And again, it's got all the functionality of the website too. You can view your benefits, EOBs, all that fun stuff too. Okay, so I believe with that, I'll turn it back over to Joe. I'm going to stick around if there's questions. Feel free to put questions in the chat if you need to, if you're watching virtually. Talk to you soon.
Okay. Thanks, Dom.
Yep.
Okay, and I should have mentioned this in the beginning, but if anyone has any questions that is joining us virtually, feel free to drop them in the chat and we will answer those at the end of the presentation. So getting into health savings accounts, I know a lot of people at MHA are in qualified high deductible plans, the plans that Dom talked about, but there are also people in the copay plan. So if you're looking to maybe switch things up, or if you're in a qualified high deductible plan and you don't have an HSA, we're just going to go over kind of like the who, what, where, when, why of the spending account. So what is an HSA? It's a way for you to set aside pre-tax dollars to pay for qualified medical expenses. and we'll touch on what a qualified medical expense is in a few slides. But the big draw to this account is that it's completely tax sheltered. So the money that goes in, it goes in on a tax deferred basis. The funds grow tax free. And if you spend the money on qualified expenses, you don't pay tax on it. So it's a really nice account from a tax advantage purpose. But there's also some other advantages. So you own this account. It's basically a checking account that's opened up in your name. It's completely portable. So if you were to ever leave MHA for whatever reason, and you go to another practice, another employer that has qualified high deductible plans, you can take this same bank account and contribute those funds from that employer, or the funds that you contribute right into this account. So it's a really nice account from that standpoint. Another nice feature is that the money, you never lose it. So it continues to roll over year. The purpose, I think everyone is familiar with a 401k, a retirement savings plan. So you can think of your HSA as your healthcare 401k. So how do I save for money? How do I save money for claims that I'm going to incur in 10 to 15 years? But also, how do I pay for claims that are going to occur in the next 12 months? So this account that's different from the retirement is you can tap into this immediately. So as soon as the funds go in, you have access to the funds, but you can also let it grow. There's some people that open up an HSA and they contribute to it, but they don't use it unless they have a major medical expense. They just use their normal debit or credit cards to pay for their everyday services. So there's a few different ways to use it, but it's completely up to you. That's the nice thing about these accounts. There are some eligibility requirements for them. So the first being that you have to be in a qualified high deductible plan. So to simplify it, if you're in the copay plan today at MHA, you cannot open up a health savings account. If you're enrolled in any of the 3 other high deductible plans that Dom talked about, you're eligible to open up a health savings account. HSA Bank, which you see in the top right corner, is the preferred bank that MHA uses, but you can use whatever bank you want. If you are enrolled in Medicare, so A is the automatic. As soon as you're enrolled in that, the contributions have to stop. So it doesn't mean you lose the money, but Medicare is the end game of the HSA. So once you age into Medicare, the funds really open up to you. Most people will use it to pay for their Medicare premiums, but you're more likely to have more health care expenses and needs when you get into your 60s. So that's when people are going to utilize these funds. But the nice thing is you don't lose the money. You just can't contribute. Another way to kind of think about this too is if you're in the copay plan today and you go into the high deductible plan as of December 1st, and next year we come back out and you say that was the worst decision I've ever made. I don't want to do that again. But I put maybe $1,000 into the HSA and you go back to the copay plan, you don't lose that money. You just can't contribute to your HSA anymore. So if you want to give it a try, you can do that and you can put money into the account, but you're never going to lose it. You can always spend it down. You can always just hold it, but you just can't contribute if you're not in a qualified high deductible plan, as long as you're not enrolled in Medicare. And then the 2 other disqualifiers would be covered by someone else's health insurance or claimed as a dependent on someone's tax return. So those are the eligibility requirements for an HSA. The IRS sets the maximum limits that you can put into your health savings account. So one thing to keep in mind, your medical plan renews on December 1st. The IRS sets these guidelines on a calendar year basis, which is why we're showing 2023 here. So if you're a single, you can do $3,850. If you're a family, $7,750. And then if you're over the age of 55, you can do an additional $1,000 on top of those amounts. So there is some flexibility with this. So when you go into Maxwell to elect your benefits, we're going to ask you, what do you want to do for the next 12 months? So we can set the payroll deduction if you want to contribute, but you do have the option to adjust that throughout the year. So if maybe, we get into the summertime and you learn you have to have a surgery next year and you want to start dumping more money into your HSA so you have some pre-tax dollars to pay for that, you can adjust that payroll deduction at that point in time. So there's a lot of flexibility with this account. You just can't exceed these limits. So that's the one thing you want to keep in mind. You don't want to go over them. Yes, and we have a question in the room.
Questions today. So I noticed I just started an HSA for the first time last year, and I noticed there's like a small amount that comes out as a fee every month. Is that because there's not a certain amount in the account, or is it the amount that I'm putting in every?
So there is, with HSA Bank, there is a fee. So it should be, I think it's probably $2.50.
Something like that?
Yeah, so it's like $24 or $25 a year to open up. It's like an administrative fee that HSA Bank takes.
Does it stop though if you have over a certain dollar amount, or is it forever?
I believe it does, but I think it's got to get, maybe, I don't want to commit to a number, but it's over, maybe $2,000 or $3,000. It's you got to have a pretty high balance for that amount to stop. But that's what it's for. That's an admin fee that they're charging. So there might be other banks that you can look to, but most people, because once you get to certain thresholds with HSA Bank, there's a lot of nice bells and whistles. So you can invest money with your HSA. You can put it into mutual funds. So that's kind of like what that admin fee is for. But for most people starting off, the investment features are not that important, but there are options to do that as well. If anyone on the virtually or in the room has a high balance, HSA Bank has an easy way to shift those funds into mutual funds. So you can park it there, and then you don't pay tax. So if any money you make on the investments just go right into your HSA. So that's HSA just has more bells and whistles than some other vendors. So, but that is normal to see that fee in there. Yes.
So this is $3,850 a year.
Calendar year.
Calendar year. But you put more after. Like,
Yep.
In other words, every year you put $3,850.
Exactly. Yep. And so the question was, can you have more than these amounts on the screen in your HSA? And the answer is yes. This is just the most you can put in a 12-month period. Okay, so what is a qualified medical expense? If you want to get technical, you can Google IRS Publication 502. That's the IRS technical listing. But for any, just generally speaking, it's going to be your deductible, your medical deductible, co-pays, prescription drugs. You can even use your HSA for dental and vision. There's over-the-counter items that you can purchase. What I always tell people is, if you're new to an HSA or you're thinking about it, go to hsastore.com. That's a website that very easily lists out what's eligible. You can see all the over-the-counter items that you can purchase. So what I do sometimes, if I'm not sure, I don't like buying stuff online. I like going to the store and buying it. So I'll go onto the HSA store website. If it's on that list, I go to Wegmans. I know I can use my HSA to purchase it. So that's a good way to spot check, or you can buy stuff right from that website. But it's a nice feature that will just easily give you a way to sort through what's eligible and what's not. So one of the advantages of this account is that you own it. It also means that you have to manage it the right way. So there are times that people may intentionally or unintentionally use your HSA funds for non-qualified expenses. If you do, and the IRS does ask you to audit, they red flag you when you file your taxes, and you do make a non-qualified expense, you'll have to return those funds to your HSA and then pay a 20% tax. So at that point, it's an issue between you and the IRS. MHA, Lawley, Univera wouldn't be able to help you kind of navigate through that process. So just make sure you're managing the account the right way. The nice thing with HSA Bank is their cards are smart enough to know what's eligible and what's not. So if you go to the store, if you go to Wegmans and you accidentally pull out your HSA Bank card, it's just going to decline at time of purchase. It's even smart enough where if you're going grocery shopping at Wegmans and you buy something that's eligible, and you swipe your card for the whole amount, it will just take off what was eligible. So I do that sometimes if I'm buying something I'm not sure, and I just want to see if I'm lucky, I throw it through, and if it comes off, it comes off. If not, it declines. So the HSA Bank, I can't speak for other banks, but HSA Bank is their cards are very smart. They know what's eligible, what's not. So that's not likely to happen, but just keep that in mind. All right, so now we're going to talk about flexible spending accounts. So this is a very similar account to the HSA that I just walked through, but there are some key differences that I'm going to point out. At MHA, you have two different types of flexible spending accounts available to you. So there is a healthcare FSA and a dependent care FSA. So the healthcare FSA is going to cover the same things that we just talked about with the HSA. That IRS 501 listing is what you can use your healthcare FSA for. The dependent care is going to be a little different, where it's more narrowed down to daycare, summer camps, before and after school programs. It has to be a licensed child care provider, so it can't be a family friend or an aunt, uncle, sister, etc. watching your kids. They have to have a licensed MPI to get reimbursement for these services. But like I mentioned, for the healthcare FSA, medical copays, deductibles, prescription drugs, the same things, dental, vision. We typically see people that are in the copay plan open up the healthcare FSA because you can't open up an HSA, so you still have an opportunity to use pre-tax dollars to pay for your qualified expenses. But when you go into an FSA, especially on the healthcare side, you're thinking more short term. How do I get through the next 12 months? And then I have to reevaluate every year. Where the HSA, you're just thinking long term. It doesn't, if I don't spend the money, that's good. Where an FSA, if you don't spend the money, you risk forfeiting it. And so you want to be careful when you do that. The nice thing with an FSA though is that you're fronted the money, right? So we'll look at the maximums on the next slide. So the IRS also sets these maximums as well. So with the healthcare FSA, the maximum is $2,850. If you elect $2,850 for January 1st during open enrollment, on January 1st, you have $2,850 available to you. You then pay that back through payroll deductions. So you can kind of think of it like an interest-free loan that you're taking out. You're just going to pay back through payroll deduction. But if you don't use that, so let's say you only spend $1,000, you're out $1,800 if you don't spend it. And, you don't want that to happen. There's nothing you can do. We can't make amendments to the plan. It's just the way that those accounts are set up to operate. There is a grace period on these plans. So you do have until March 15th of the next plan year. So if you're currently in the FSA today, you have until March 15th of 2023 to spend down all your funds from the current year. So there's, a little bit of a grace period to spend down those funds, but it is, a use it or lose it type account. On the dependent care side, it's going to work just like the HSA, where you can only use what you put in the account. So if you are married and you file a joint tax return, you can do up to $5,000 in the dependent care account. If you are married and file separate returns or single, you can do up to $2,500 in your dependent care account. But that is only what goes into your account. So if you elect $5,000, if you do that divided by the number of times you're paid, each paycheck, that's how much you can pull out from the dependent care account. And that's the same way the HSA operates. So these are, it's nice to have these spending accounts, but just know that there are some rules, there are some key differences between them. And, what can you, I guess a question we always get is, what can you pair both an HSA with an FSA? And the answer is no. If you're just going to do the healthcare FSA, you can't do a health savings account with a healthcare FSA. But you can do a health savings account with a dependent care account, because those are two different types of avenues that you're spending the funds, one on daycare, the other on qualified medical expenses. So just keep that in mind when you're electing your benefits. Yes.
So for the FSA, that's upfront, but for the HSA, you build that up. Is that correct?
Yes.
Okay.
Yep. Okay, so we do have a question in the chat. Chris, I'll answer that one at the end of the presentation. Thanks for dropping that in there, though. All right, so now we're going to get into some of the non-medical benefits. So at MHA, eligible employees are given a basic life insurance, short-term disability, and long-term disability benefits. So these are really nice benefits that the practice provides to all eligible employees. These are benefits where we hope no one ever has to use. But if something does happen, there are products that will either indemnify your family if there's a loss of life, or if you go out on a disability, there will be income coming into you if you're unable to work. So keep those in mind. When you go into Maxwell, you'll see what the coverage levels are. They're all salary-based benefits. So just keep that in mind that they're there. It's not common that employers provide this many employer-paid benefits on the non-medical side to their staff. So they're really nice benefits that MHA provides. And just keep in mind with the basic life insurance and even the voluntary life that I'm going to talk about, it's important every year to go in and update your beneficiaries. Make sure that if something does happen to you, the funds that MHA provides you on the basic life insurance side, or if you buy the supplemental life insurance, that the funds are going to be directed to the person or people that you want them to go to. So it's important to do that every single year, and you can do that right in the Maxwell Health Portal. So like I said in the beginning, the life and disability benefits are going to be switching from Hartford to Guardian on December 1st. So with that, if for anyone that is in the voluntary life plan, or if you previously waived it, there's going to be a special re-enrollment for this product. So voluntary life insurance is, it's term life insurance. So it's pretty inexpensive. When you go into the Maxwell portal, you can kind of play around with what the costs are. But this is paid for by you, the employee. You can elect increments of $10,000 up to $500,000. There's a guarantee issue amount of $150,000 if you're under the age of 65. So just keep that number in mind. And then if you insure your spouse, or if you insure yourself, you can insure your spouse and your children's spouse. You can go increments of $5,000 up to $250,000, not to exceed 50% of your amount. Guarantee issue on the spouse is $30,000, and children you can elect your children in increments of $2,500 up to $10,000, not to exceed 10% of your amount. So with the special re-enrollment, if you previously waived the term life insurance in the past when you're first eligible, or if you were enrolled, you dropped it, whatever, this year you can enroll up to those guarantee issue amounts. So an employee, $150,000, your spouse, $30,000 with no health questions. So it's a really nice opportunity for people that might not be insurable elsewhere. Either it's you or your spouse. You can get up to $150,000 for yourself, $30,000, no health questions. So take advantage of that this year. If you're interested, you'll be able to do that right on the Maxwell portal. If you are someone that's currently enrolled with Hartford today and you have more than the guarantee issue amounts that are listed, Guardian's going to grandfather those amounts. So you don't got to worry about filling out health questions. And if you're someone that wants to go over the guarantee issue, that's fine. But you will have to fill out evidence of insurability, which is a health questionnaire. But anyone that's previously waived, you can get up to those guarantee issue amounts, no health questions. So that's a really nice benefit to take advantage of. And if you do waive it this year, just know next year, even if you want to get $10,000, you're going to have to fill out health questions. So that's why it's important just to kind of get the word out, let your colleagues know about the re-enrollment on the voluntary life. So now we're going to move into the dental, vision, and then some of the other Guardian benefits that are offered. There's no changes to these benefits. The one thing you will notice with the dental when you go into Maxwell is that the rates did actually decrease for this year. So they went down slightly, not a huge dollar, but about 5%. So you will see a slight rate reduction when you look at your pay stubs with the first pays in December. But just to go over high level, there's two plans. So there's a high plan and a low plan with Guardian. Both of the plans incent you to go within the network. So if you look at both plans have in and out of network coverage. We're going to look at the high plan specifically on this page, then we'll tab over to the low plan. But you'll notice that the in-network cost shares are higher for you. So it's important to go to in-network providers. Guardian has a really robust network in Western New York. So it's tough not to find a Guardian dentist. You do have the option to go out of the network. That's totally up to you, but just know that you are leaving some money on the table. The way these percentages work, so your preventive services are covered at 100%. Keep in mind that if you're on the medical plan, you can reimburse to Univera, get $100 back. So it's no cost to you. And then you can also reimburse yourself through the medical plan. So keep that in mind as you're kind of moving throughout the year. Basic services are covered at 90%. So that means that Guardian will pay 90%. You're going to pay 10% of the service. So a basic service would be if you have to get like a filling, for example. Major services are covered at 60%. So Guardian covers 60, you cover 40. So major services, are going to be crowns, bridges, et cetera, things like that, more higher priced items. So although it's only a 10% difference in or out of network, 10% of a couple $1,000s is a lot of money. So that's where you're going to want to go in network to make sure you're getting those major services. Even basic services, it's significant dollars. It's not negligible amounts of money that you're leaving on the table. So it could be big dollars. No deductible if you go in network. So again, you're incented to go within the network. The annual maximum is $1,500 on this plan. So that means Dom talked about the out-of-pocket maximum on the medical. So once you hit that on the medical, Univera covers everything above and beyond that. On the dental, it's the opposite. Once you hit that number, Guardian stops paying. you pay everything above and beyond that. Most people don't have over $1,000 in dental services in a year. Obviously, the outliers would be if you're getting crowns, implants, dentures. Those are very high priced services, but those don't happen as frequently as you might think. And then there's also a maximum rollover feature on this plan. So what that means is Guardian will roll over some of your unused funds to the next plan year. So you don't need to do anything except go to the dentist at least once and have less than $500 in services. So really, if you're going for your preventive services, nothing major, or if you don't have to get maybe even one filling, you'll still be under $500. You would qualify. Guardian will roll over some of your unused funds to the next year. Similar to Univera, Guardian has a member portal, guardiananytime.com. You can register to see if you've ever qualified. So some people in the room, this is just your starting point. Some people may have a higher annual maximum than others. Even within your family, the annual maximum, if you have a family plan, is per belly button, per person in your family. So it's not just one number. So that's just the starting point. There's ortho coverage on this plan, 50% to a lifetime maximum of $1,500. And dependents on both plans are covered to age 26. Won't spend a lot of time on the low plan. It operates the same exact way as the high plan. You will notice that obviously with it being the low plan, there's less coverage. So you'll see that reflected in the percentages that you would be responsible for. Still no deductible. Annual maximum is $1,000 instead of $1,500. And then the ortho is cut in half. So it's 50% to $750 lifetime maximum. Getting into the vision plans, you'll notice that there's no change in benefits, no change in costs for the vision for this year. You have two networks to pick from. I think that's the easiest way to go about the two plans that you have available to you. The first plan is going to be the VSP network. It's through Guardian. So, high level, if you were to ask me, very briefly, what's the difference between VSP and Davis? VSP are going to be your individual mom and pop optometrist. Davis is going to be big box retail. So those are really the very high level differences between the networks. However, VSP is the largest network in the country. Davis is the third largest. There's going to be a lot of overlap between the two networks. So what I typically tell people, if you're new to the plan, find out who your dentist or who your eye doctor participates with, and then pick your plan based on that. The costs are very, very comparable. The way this works, eye exam is covered every 12 months at a $10 copay, frames every 24 months. On the VSP plan, you get up to $130 allowance. So you get $130 and then 20% off anything over that for frames. If you wear contacts, you get $130 allowance, and you can get contacts or lenses for your glasses every 12 months. You can't do both in the same month, same 12-month period. So just keep that in mind. On the Davis plan, it's going to operate almost the same way. There's just one small benefit decrement with this plan. So your frames, you'll notice that you get $120 allowance as opposed to $130 with VSP. You can still get the frames every 24 months. With your contacts, you can get, every 12 months, you can get contacts, $120 allowance. But with the Davis plan, it gives you a 15% discount on anything over that 120. Or VSP, you just got the allowance and that was it. So there are some small minor differences between the plans, but overall, they're going to operate essentially the same way. Now we'll move into some of what we call the worksite or voluntary benefit offerings. So these are going to be accident, critical illness, and hospital. I think most people are familiar with Aflac or have seen the Aflac commercials. These are very comparable. They're the same types of benefits where if you go out with an accident, you will be reimbursed an amount. There's a schedule that Guardian has for the accident plans. When you go into Maxwell, you'll see it's probably like a 3 or 4 page summary. And it's just going to list if you go to the hospital and you're on the Premier plan, this is how much you would be reimbursed if you were to be admitted due to an accident. This is a very popular benefit with any families that have young kids, maybe playing sports. So there's an increased risk of an accident occurring. And maybe you're in a high deductible plan and you're concerned about how do I cover a deductible if something like that does happen. That's the intention of these plans, is to kind of give you that financial security that if something does happen unexpectedly, there's some financial protection for you. So on the accident side, there's 3 plans: a Premier, Advantage, Value. Premier is the most expensive when you look at what the cost is going to be, but it's going to give you the most coverage. Value is going to be the cheapest, but it's going to give you the least amount of coverage between the 3 plans. It's tough to spreadsheet these and present them just because there's so many options. So if you're interested, when you go into Maxwell, make sure you look at the benefit summaries to see what those dollar amounts will be if you were to have to seek any medical treatment due to an accident. Dependents are covered birth to age 26. And if you were to leave MHA, you can take this plan with you as well and do a direct pay with Guardian. The next plan is going to be critical illness, also known as specified disease. So as the name of the plan kind of hints at, this is going to give you protection for a specific list of conditions. So we have them listed on the screen, and that is actually the full listing of what is covered on this plan. So it's going to be heart attack, cancer, stroke, kidney failure, etc. I'm not going to read it all, but people that buy these plans may have a family health history of any of these conditions. And what you can do is you can elect benefits of increments of $5,000 up to $20,000. So the max you can have is $20,000. And if you're diagnosed with one of these conditions, you would get that lump sum payout to help offset any medical costs that you'll have. Some of the benefits will pay a reoccurrent benefit. So there may be, you may not get the full benefit amount, but you may get 20% of what you elected if it happens again. So just keep that in mind. Again, review the benefit summaries. We're happy to, once you look at them, happy to go over these in more detail with you. But they're nice benefits that are offered. With this plan, just keep in mind there is a pre-existing look back. So if let's say you buy this plan for December 1st and you submit a claim in December, Guardian's going to look back 6 months from the effective date. If you sought any medical treatment, advice, took any prescription drugs for any of these conditions, they would deny the claim. So just keep that in mind, that if there is something pre-existing that you're not likely to have a claim payout, you theoretically could, but you need to be covered for 6 months before that claim would pay out. So it's not an outright exclusion, but they're not going to pay it immediately. And then there is a wellness benefit on this plan. So if you are getting, let's say you go for your routine physical on the medical, that's no cost to you. You can submit for a $50 wellness benefit on this plan. So if you do have this plan today, you can take advantage of that. That's not a new benefit. I know we've had this plan for a couple of years. And then the last benefit is going to be hospital indemnity. So this plan will reimburse you if it's very simple. If you have an admission to the hospital, you'll get $1,000 reimbursement. So again, these are benefits that they pair well with high deductible plans. But with all 3 of the benefits, they don't need to be used towards your medical expenses. So obviously, if you have an accident, if you get diagnosed with one of those conditions that we talked about, or if you're admitted to the hospital, you're most likely not going to be at work. So you're going to have other bills to pay. You can use these funds as well. They don't need to be, although the intention is to help offset your medical expenses, you can use them on what you see fit. So nice benefits to have. And we're happy to talk through these, once you get a chance to really look at them and look at the benefit summaries. And then our last, reminder just to everyone is at Lawley, we have a Medicare and individual health team. So if anyone in your family is aging into Medicare, or if you have a friend, we can talk to them. We have a team of people that, we're carrier agnostic. We don't work with any carriers. We'll sit down with you, find out, what are your health conditions? What prescription drugs are you on? And then April, I won't do this. April would help pick a plan that makes sense for you with a carrier that makes sense for you. So this is a no-cost service as employees of MHA. So feel free to take advantage. Like I said, it doesn't need to just be you. If you're someone that's a little bit younger, your parents are aging into Medicare, feel free to utilize April. We just opened up an office in the Southgate Plaza specific to Medicare. So if anyone lives in the South Towns in West Seneca and you're familiar with the Southgate Plaza, you're free to just walk in there, let them know you work for MHA, and we can help you out. So just a reminder, it's a nice service that we offer that a lot of people do take advantage of. Okay, so to wrap up, we appreciate everyone joining us for the last 15 minutes to learn about your benefits. You have a very robust benefits package here at MHA, so there's a lot of information that we just threw at you, but we're here to help you throughout the process. So as I mentioned, all the benefit elections will be done through Maxwell, just like they have in years past. All the benefit summaries, everything that you need to know will be uploaded into the portal. Univera did print out some nice booklets that kind of goes in depth on the medical plan, a little bit more than the PowerPoint slideshow. So feel free to look at that. But otherwise, it's going to be pretty much status quo if you're not making any changes. The big thing, if you're on the medical plan, keep a look for those ID cards towards the end of November. And if you're interested in the voluntary life insurance, now's the time to do that if you previously declined to enroll in coverage. Like I said, HR will be sending out communication on when you can actually go into the portal. But just like last year, it's going to go to your email. Once you get that email, go in, elect your benefits. It should be a pretty streamlined process. If you don't get an email from Maxwell at the time that HR says that the communication will go out, and you have this PowerPoint slideshow, we do give some instructions, the website to go to right in the PowerPoint. For anyone in the room, if you just keep this handy, the last page of this will kind of give you instructions on what to do if you don't get the email. But other than that, that's all that we had. Any questions in the room? Yes.
Sorry. So for the voluntary life insurance, I have two questions. One, so there's no questionnaire now for the obviously health questionnaire. In the future, will there be one, or is that kind of waived until?
Yep. So that's so the question is there any health questions in the future? So if you join the plan today, will you be asked health questions next year?
Yeah.
Yep. So the answer is no to that. So if you join the plan now, you won't have to answer any questions. The only time you would is if you want to increase your amount.
Gotcha.
So that's why, the guarantee issue, most people might say, if I can afford it, I'll just go right to the guarantee issue. That way I don't have to bump up next year. But whatever you decide to do for this year, you'll be locked into no health questions unless you want to make a change in the future.
Okay. And then, sorry, second question. If for whatever reason let's just say, decide to be a stay-at-home mom, does that kind of disappear, or does it how does that work?
With the life insurance?
With the life insurance.
Okay, so the question was, if you no longer work at MHA, does that life insurance go with you? And the answer is yes. So there are options. Either you can convert it to a whole life policy, which becomes a little expensive, or you can port it and you can keep the term life policy that you have. So yes, there would be two options for you to take that with you.
Okay, thank you.
Okay, and then if there's any other, if anyone on the call has any questions in the chat, feel free to drop them in. So I'll answer Chris's question here. So if you have a qualifying life event, spouse loss of insurance due to their job change, for example, do you have to stay in the same plan to add him or her, or can you switch the plan? Yeah, so
Yeah, I can take that, Chris. So if you're adding a dependent, you can change the plan. So marriage, spouse, your example, spouse loses the job and comes, on the MHA plan, you can change plans at the time when you're deleting a dependent. So divorce, kid ages off, you cannot change your plan. Okay, so that's how that works.
Okay. And I think one thing to keep in mind, and Dom, correct me if I'm wrong, if you do change your plan and you're in a deductible plan, the accumulators do reset.
Yeah, be
Right.
mindful of that. You want to look at, obviously going from a high deductible to a copay plan, that's different. But if you're in if you're in a high deductible plan, you go to a different high deductible plan, that doesn't transfer. So.
Yep. So just keep that in mind. But good question. Any other questions in the room or in the chat? I think we'll be wrapping up. Okay. Well, thank you, everyone. Hopefully you found this helpful. And like I said, Dom and I are here. If anyone has any questions, anyone virtually can email them to HR, and then we will be sure to get those answered for you. So thank you again.